So as you can look at it, okay. So Nifty is an index. Nifty is an index which represents the market's current performance. Okay. So it is nothing but the status of the market at the present time. That's it. So if you look at the figures of the Nifty, it was somewhere between 0 to 2000 in 2000s. It has grown to go over 20,000 in this year. It had reached 19,000 in this year. It has reached 20,000 in this year. So if let us say you had invested in MRF, TCS, any stock of your choice in 2000, which were at the time the Nifty was at 1,400. If you had left it alone, you don't need to do anything. You just buy TCS shares for 1 lakh, 10 lakh, whatever amount. You leave it alone, it would have grown by 19 times. 19 or maybe 16 times. So if you look at the whole trend of the market, it has always been an up move. It has always been an uptrend. So there is no risk of any depreciation of the asset. It has always been an appreciation. It may be an inflation correction, but it has beaten the inflation and gone above to prove that it has a very good asset class. Okay, now coming to what is the stock market? Everybody understood why we need to invest in the stock market. Anybody have any doubts? Any language is fine. Hindi, Kannada, English. Okay, coming to what is the stock market? Now, stock market is actually a marketplace where all stocks or shares are traded. Now, it is frequently used to refer to the secondary securities market. When you look at what is a security, it is referred to the secondary market. Primary market also comes under stock market, but in layman's usage, the primary market is told to be a separate entity. It is called a primary market rather than a part of the stock market. So now it refers to the marketplace where shares are transacted. It also includes the primary market, but layman's terms, primary market is separate. Now looking at what are shares. Okay, now let us say you open a company. Let us say your name, sorry, Prithvi. Prithvi opens a company, Prithvi and Co. Let us say it is something to do with the food industry. He has a capital of around say 50 lakhs that he is ready to invest in the company. He invests it, he starts the company, he runs it for let us say 1 year, he runs it. After running for 1 year, the company is making a substantial amount of profit and he is looking to expand the business, but now he has no capital left. So what is he supposed to do now? What are the options available for someone looking to expand their business and don't have capital in their private account? Okay, we'll look at it later. That will be the last one. Before that, loans. Okay, debt or loans from any institution like banks or third-party institutions. That's a good option, but you will have to pay interest. Anything else? Okay, someone can offer to invest in his company. Maybe a venture capitalist, maybe a private equity holder, or maybe a partner, maybe a promoter, anybody. All these people are called promoters in a single term. Venture capitalists you would have heard. Private equity is similar to a venture capitalist. You would have watched Shark Tanks. Anybody has watched? Okay, most of them are private equity holders. The concept is you sell part of your the shares of your company for a certain amount they put in, but they don't trade it like they do it in the open market. So they are called private equity holders. Now this share, okay, looking at what Pamisha said, shares can be sold in the open market. Now the meaning of this is that, let us say you have a 50 lakh business just like Prithvi and Co. You want another 50 lakhs investment, but you don't have the enough capital. You don't want to take a loan, so because you don't want to suffer the burden of interest. So no one is ready to invest in your company. Maybe they are all foolish. They don't have the right mindset that you have. Now what you can do is, you can offer to sell a share of your company. That is, you have 100% ownership until now. you are willing to sell a part of this ownership to somebody else, a third party person, and it could be anybody. You are ready to sell it to them in return for a capital investment from their side. So you are trading your ownership rights. So this ownership rights, let us say he has traded 30% of his ownership, which is 30% of the total shares. He has given it to the third party person in the market. He has given you some capital, let us say 50 lakhs. So looking at that, each share would be costing around, so 50 lakhs by, let us say 30%, let us say that is around 3,000 shares. 3,000 shares, meaning you have 3,000. So that will be somewhere like 1,400 per share, 1,300 to 1,400 per share. So each share will be now costing 1,400 for him. He is ready to buy 3,000 shares at an amount of 50 lakhs. So he's taken up 30% of the ownership. He gets 30% rights in the company. So you plan to put up another factory or another any other investment. He'll have 30% of the right in the sale. You'll have 70%. So your vote will carry 70% weightage. So let us say you plan to open a factory. When you plan to open a factory, you take up votes in the board so that you know whether it is a right decision or not. Your perspective may be different from someone else's perspective. Your analysis would be different from someone else's in the board. So when you take up a poll, you will have 70% say. So your one vote will carry 70% weightage. His one vote will carry 30% weightage. That is the meaning of 30% ownership. Now these shares, so 30% was 3,000. So 100% would be 10,000. So there are 10,000 shares, out of which 7,000 you hold, 3,000 are given to someone else. So 3,000 shares are in the open market. He can sell it to anybody else for any other price other than the 1,400 per share. He can sell it to someone else. He can buy it from someone else. He can sell half of it. He can sell just 2 shares maybe. He can do whatever he wants in the open market, and that is what we call the share market. A promoter is a part of the company, and just like I told you, shareholders are everybody who hold a share. Be it 1 share, be it 100% of the share, everybody is a shareholder. So, next. Okay, to put it in simple terms, simple ಆಗಿ ಹೇಳಬೇಕು ಅಂದರೆ ತರಕಾರಿ ಅಂಗಡಿಗೆ ಹೋಗ್ತೀರಾ, ಏನೋ ಒಂದು ತರಕಾರಿ ತೊಗೊಳ್ತೀರಾ, ಟೊಮೆಟೊ ಅಂತಾನೆ ಅಂದ್ಕೊಳ್ಳಿ. ಟೊಮೆಟೊ ತೊಗೊಳ್ಳೋವಾಗ ತರಕಾರಿ ಅಂಗಡಿ ಶೇರ್ ಮಾರ್ಕೆಟ್ ಆಗುತ್ತೆ, ಟೊಮೆಟೊ ನಿಮ್ಮ ಶೇರ್ ಆಗುತ್ತೆ, ನೀವು ಕೊಡೋ ಬೆಲೆ ಅದರದ್ದು ಪ್ರೈಸ್ ಆಗುತ್ತೆ, ವಿಚ್ ಇಸ್ ದ ಸ್ಟಾಕ್ ಪ್ರೈಸ್. So let us say you've bought 5 kilos of tomatoes for 100 rupees, which is 20 rupees per kilo. So each share would be 1 kilo of tomato. Everybody can see it. So let us say you buy 5 kgs for 100 rupees. So 1 kg of tomato is, let us say, is 1 share. Its price is 20 rupees. So this is the share market. In a bigger aspect, in large scale, you trade shares, not commodities. So other financial instruments, okay. Okay. Looking at other financial instruments, the financial market is divided into 2. The capital market and the money market. Money is money and its equivalents. Capital market deals in debt and equity. Okay. Mutual funds are also in this part, capital market, not in the money market. So they either invest in debt or equity. Equity is further divided into primary, secondary, and derivatives market. We'll be looking at it later. So money market contains the treasury bills. If you have seen Scam 1982, I don't know how many of you have seen. Yaryar nodidira? Anybody who has seen? Okay. After the 3rd and 4th episodes, we'll be dealing completely in treasury bills. If you look at the series, they've beautifully shown it, but I won't be able to explain it here. It's not useful in the market, so we'll leave it alone. Now coming to the next point. Okay, now let us see how the equity market functions. Just like any other market, the price of the product is based on the demand and supply of the people. So let us say 4 months ago, tomato had shooten up to 200 rupees per kg. That was because there was a shortage in the supply and there was the regular demand in the market. There was not an increased demand, but there was a shortage of supply. So that is the reason the farmers took advantage, not the farmers per se. The middlemen in the agricultural products industry, they have taken advantage. They've sold tomato for 200 rupees per kg. They've made huge profits. Now the supply is well enough to meet the demands. The rate has come down to 20 rupees per kilo. So this is the base, or this is the backbone of every market where products are traded. Supply and demand. Now, earlier days, there was something called as a physical share. You don't have the present digital era before 1990s or 2000. Before 2000, you didn't have this, so many computers, so much internet connection, or so much technology. So there had to be something where you would write something or have a record of something. So these were all in the physical format, called as a share certificate. You can look at a share certificate of Hindustan Motors Limited, showing Akhand Bharat, of course. And this share certificate will depict the name of the shareholder here, at what price it was bought and what date it was bought, and he'll have the share certificate with him. This is the proof that he has an ownership, whatever be the amount, he has an ownership in that company, which is Hindustan Motors Limited. In 1980s and 1990s, when many people fell into the stock market, the amount of trade or amount of transactions were so high that record keeping in the physical format had become hell. So there was something called as a dematerialized format introduced. Now this dematerialized format, short form Demat. Demat is the digital format of a physical share. That's it. This is called a share certificate. It's a certificate that you hold ownership. So it's a share certificate. Its modern counterpart is the Demat account, or the Demat format of shares. Now, if you have had grandparents or parents who had invested in any company in 1980s, 1990s, or any time before that, they would be having share certificates. Present day, you can't trade these share certificates in the physical format. You will have to dematerialize them before trading them. So this can be done with any of your broker. You open a Demat account first with the broker in whom you have opened the Demat account. You go with them, you submit the physical share, they will look at their end of records to verify that this share certificate is valid or legit. After that, they will convert this physical share into a dematerialized format. They will deposit this share in your Demat account. We'll look at what is a Demat account later. Next. Coming to the middlemen in the stock market, we have the major role is played by the stock exchanges. Of course, Bombay Stock Exchange was the first exchange in Asia, 10th exchange in the international market, set up in 1875 by a Gujarati called Premchand. Gujaratis are okay. Now we have two entities in India. One is the Bombay Stock Exchange, the other is the National Stock Exchange. Both of them play a role of an exchange. An exchange is nothing but the stock market. It is the marketplace where every transactions occur. They form a base where all transactions are occurring. So they take care of the listing of a company. Let us say Prithvi & Co. wants to list their company in the stock exchange so that their shares can be traded. He will have to do it through the stock exchanges, either NSE or BSE, whichever he wishes to, or maybe both. They will also look over the transactions between the buyers and sellers. They will ensure the liquidity and price transparency. Matching of orders is one of their main tasks. Now, the stock exchange gives you the marketplace where transactions occur. But after buying the tomato, where do you keep it? You keep it in the fridge, of course. So this record keeping entity is the depositories. You have NSDL and CDSL. There is no difference between both, but they are two different entities. National Securities Depository Limited, Central Depository of Securities Limited. Both are, you don't need to actually see which is better. It is almost the same, NSDL and CDSL. They hold the records of your shares. Whatever transactions you do, whatever price, whatever volume, whatever amount, everything, they have a record of it. So this clearing corporation, which is NSCCL and ICCL, they are all subsidiaries of the NSE and BSE. You don't need to know much about this. You need to know what is the stock exchange, what is depository, and what is SEBI. This is not necessary, but they take responsibility for the settlement of the shares. Settlement is a complex thing. We'll look at it later. SEBI takes over the security and regulation part of the market. They draft rules, they draft regulations, they look into the law and order of the market. They make sure that nobody is defaulting anybody, nobody is going against the rules and regulations. And of course, more importantly, we need to have a middleman. In a market, there is a vendor who is giving you the tomatoes in exchange for your cash. The vendor is nobody but a broker. So the market is the stock exchange, the product is your shares, the investment is your money, the vendor is your broker, the place, the godown or the fridge where you keep your products is the depositories, and the clearing corporations are nothing but a third party who settles the transactions between the vendor and the purchaser. So brokers, there are two types of brokers. Before looking at that, we'll look at the short clip from Guru, movie by Abhishek Bachchan. I'm sorry, there's no speakers in this, but just look at the visual. That's it. As you can look at this. At this visual, you can see many people shouting something. There are people standing above, there are people standing down. Each of them are shouting something. They have notebooks in their hand, they are writing something. They are basically matching transactions. So maybe let us take this person. This person, he wants to, this was the cotton market or the textile market actually in the movie. Let us say this is an auction. The people down are bidding in the auction to purchase textile. The people above are noting down what are the bids of the different people, and they will supply the products to the highest bidder. So these, let us say this person wants to buy, let us say 1 yarn of fabric or 1 yarn of cotton for 50 rupees. He will say that I want it for 50 rupees. He's bidding it for 50 rupees. Bid and ask are two concepts that is used in the present day also. So he is bidding for 50 rupees. He is willing to purchase 1 yarn of cotton for 50 rupees. This fellow is bargaining with him. He is saying now the price is 55 rupees में चल रहा है, तो इसलिए 50 में नहीं दे सकता है. Both are bargaining. The one who clears is the clearing corporation. So they settle at 52.5 rupees. Transaction done. He notes down the name of the person. He notes down 1 yarn of cotton at the rate of 52.5 rupees for delivery. So this was what was the situation in the olden days. These people who are, this person who was noting down the transactions, he was called a jobber. A jobber was also in the Scam 1992 series. He played a very important role. He was under broker. He used to settle transactions, note them, and deliver the share certificates to the owners. Now the modern day jobbers, there is no more jobbers now. There are only brokers in today's world. This broker The broker is here. Stock exchange is the marketplace. All orders placed through the broker in the stock exchange will be matched. After this, after the orders are confirmed and the trade is placed, the broker settles the shares with the investor and takes the money from the investor. He gives it to the exchange and it goes to the concerned department. Now the clearing corporation takes care of the settlement between the bank, the investor and the broker. They credit and debit the money and shares from the respective people. So shares from the broker will go to the investor, money from the investor will go to the broker because of the clearing corporation. Now looking at the types of brokers, this was all a conceptual aspect. Now looking at the practical aspect, you need to know this so that you understand how the market works. But for any person willing to open a Demat account with a broker, you don't need so much. You just need what are the types of brokers and what are the aspects that you need to look at. So there are two brokers called full-time brokers and discount brokers. So full-time brokers are your old brokers like ANAND, RATHI, Motilal Oswal, Edelweiss, Franklin Templeton, or others. Then discount brokers are the modern brokers like ZERODHA, Angel One, Grow, 5 Paisa, Sher Khan, all these people. So the difference between them is the charges that they make. So these brokers, they take a part of your commission. They take a part of your capital as the commission. They need to survive. They are a business, so they need to look at profits. So that profit is the commission that you pay them for every transaction that you make through their broker. So depending on the commission, we have full-time brokers and discount brokers. The full-time brokers, they have a flat fees. This flat fees will be somewhere between 20 rupees or 0.2% to, so it will be 0.2% to 0.5% or sometimes 1% of your capital. Say you buy a share for 1 lakh, they will take up 1%, which is 1,000, which is a huge amount. When compared with the discount brokers who take up only 0.02% to 0.05%, which is 20 rupees. So this difference will obviously make all the small-time investors choose discount brokers. But the advantage with full-time brokers that all the large investors choose is that you have personalized services. When you are a very large investor, you will look at small movement of, let us say 0.5 paise, 5 paise or 20 paise. This small movement matters. All these small movements can be easily settled by a full-time broker rather than a discount broker. So the prerequisites for for trading in the stock market will be 3 accounts. One is the bank account where you have the money. The second is the trading account through which you make transactions. The third is your Demat account where all the bought shares are parked. So money goes into the bank account. Demat account holds the shares. Trading account forms a bridge between the bank account and the Demat account. And other than this, what else you need to trade in the stock market? Mr. Harshad Mehta will tell. There's no speaker. Okay. Basically, he is talking about the market का मसाला. Market का मसाला में 5 चीज़ होता है. इसमें first tip और खबर or the information that a particular stock would rise or would fall. That is the first masala. The second masala.
मार्केट का मसाला ना 4 चीजों से बनता है.
Anybody can hear? First was the information or the tip or as to which company will fall or which company will rise. The second was the risk. रिस्क जितना ज़्यादा उतना ही टीका होता है मार्केट का मसाला. इसका मीनिंग है कि आप बड़े रिस्क लेने के लिए तैयार है तो बड़े रिवार्ड्स मिलेगा. और आगे थोड़ा भावना क्या होता है, कौन होता है, ये पूछता है. भावना है इमोशंस. So your emotions of fear or excitement or enthusiasm have to be controlled strictly to function well in the market. Fifth item is your luck. So in the stock market, maybe like I said in the global or national crisis, that all depends on pure luck, 100% luck. Nobody can do anything in that. So looking at what factors affect the price of a stock, I think with this we'll be ending today's session. We'll look at the timings, settlement we'll take up tomorrow. So we'll look at two more aspects, which is the price determinants and the timings. So price determinants, the factors that cause the market to go up and down. The basic factor is your supply and demand. Supply less, demand more. What happens? Price increases, decreases? Increases. Supply more, demand less. Supply, demand same. Continues to move in the same ratio. Now market indicators, we look at what are indicators later. The confidence index, the people का emotion बड़ी चीज होता है market में. You understand the emotion of the people trading, you will learn to trade better. So understanding the emotions, you need to know whether the majority of the traders are enthusiastic, which means they are buying shares, which increases demand, so the prices go up, so you need to act accordingly, or vice versa. Then wars and other conflicts, wars, the Russia-Ukraine war last year, that had made the stock market go down a little after it had risen up above the COVID levels. Now inflation and deflation, just like I said, inflation and deflation correction can happen in the market. The market is also an commodity, so shares may also increase with inflation or decrease with deflation. The government fiscal and monetary policies, they play a very important role. Technological changes, any company, let us say in the automobile industry, they have a new technology, let us say hydrogen run engines. Some company like let us say Mahindra and Mahindra make a breakthrough in hydrogen run engines. Their shares are going to increase because it's a good thing to their company. They're going to get profits. The profits are going to be shared with the shareholder. Shareholders are happy. Shareholders happy meaning they'll buy a lot. They're buying a lot meaning demand goes up. Demand goes up meaning prices go up. So natural disaster or extreme weather events that can also cause the market to collapse, or relief from them, or very good management or handling can increase the market. We can't say corporate or government performance data. We can look at the performance of the companies in the last 1 year, 5 years, 10 years, 15 years, 20 years, 50 years. Depending on their performance, the market, the shares price of their company will go up and down. Depending on regulation, deregulation, let us say there was some regulation by SEBI that above 1 lakh you can't invest in the market. This is a deregulation or a negative regulation. So that will upset all the people who have already invested more than 1 lakh. So they are going to withdraw their money from the market. When they are withdrawing the money, they are selling the shares. When they sell the shares, the supply increases but demand is less. So naturally, share prices are going to fall down. So this is one example of regulation and deregulation. Level of trust in the financial sector. You trust the market, it rewards you well. Level of trust in the legal system. If SEBI does not look after default or frauds in the market, they let frauds happen continuously. How many of you will invest in the market? Nobody will invest. If nobody is investing, where is the demand or supply? So prices are going to fall, or maybe markets are going to stay barren. So all these, as Yoda says, may the force be with you and may you invest well. Now the final concept of today, which is timings. So timings is a little difficult to understand, but I think I can make it a little easy for you. So let us understand the Indian market works on the Indian Standard Time, which is the IST. So Indian markets function properly from 9:15 AM to 3:30 PM. All transactions take place at this time. You don't go to Reliance after 10 PM in the night. Just like that, you don't transact in the market after 3:30. but there is a small difference. So this is the actual market hours. Market hours is 9:15 to 3:30. Now there is something called as a pre-opening market session that happens before 9:15 a.m. This session is from 9 to 9:15. What happens in this pre-opening market session, we'll look at after seeing the post-market session. So the post-market session is from 3:30 to 4 o'clock in the evening. So this post-market session is not open to everybody. Okay, retail traders cannot trade in the post-market session. Only brokers can transact in the post-market session. Why it is important, we'll know when we look at something called as a short sell. This is a concept in the market for placing a transaction. When we look at this, we'll understand what happens during the post-market session. Now the after-market session extends from 4 p.m. to 9 a.m. of next day. This is the after-market session. So what happens in the after-market session is, as I told you, you won't go to Reliance Smart or Big Bazaar or more mega store after 10 o'clock in the night, because they are going to shut down. They won't take up any trades. But the market is a bit special. You, let us say it is exactly like Zomato or Swiggy. You don't go dine in a restaurant after 11 o'clock in the night, but they do deliver. So between 4 and 9 o'clock, let us say you have some news or you have some hunch that let us say TCS is going to go up tomorrow. Tomorrow, first thing in the morning when the market opens, TCS prices are going to go up. You get to know that after 4 o'clock. You can't place trades. So this after market session was brought to solve this issue. To solve this, they have the provision of allowing orders to be placed. Now there is a difference between an order and a trade. An order is an open transaction. An order is an open transaction. You are saying that you want to buy, let us say, a t-shirt at 300 rupees, but you haven't paid the money and received the t-shirt. So it is an order. Let us say tomorrow morning your tailor gives you the t-shirt at 200 rupees. He gives you the t-shirt, you pay him 200 rupees, that is when it is said to be a trade. Okay. So open transactions are orders, fulfilled transactions are trades. So you can place orders in the after-market session. The trades don't occur here. The trades, when do they occur? They occur in the pre-market opening session. Before the market opens, 15 minutes, you have the pre-market opening session, during which the orders that were placed here convert into trades. So, anybody who has placed an order between 4 o'clock yesterday and 9 o'clock today morning, anytime you can place it even at midnight, 1 o'clock, 2 o'clock in the night, you can place the orders. After placing the orders are matched between this time, but not exactly this time, between 9 to 9:07 a.m. All these orders, you can further place orders between this time, 9 to 9:07. Let us say you forgot to place your order yesterday night. You remember it morning when you wake up at 8:55. So you log in, by the time you log in, maybe 5 minutes have elapsed, but after 9 o'clock until 9:07 a.m., you can place the orders. 9:07 to 9:15, sorry, 9:12, the orders get converted into trades. All your orders are matched with relevant orders on the buy or sell side. If you take up a buy order, someone who's selling, your order and his order will be matched. If you are taking on the sell side, someone who's buying, their order and your order will be matched. This will be done between this period, 9:07 to 9:12. 9:12 to 9:15 is a power nap period for the market. This 3 minutes is when the market stabilizes. Market needs to stabilize because this 9:15 to 3:30 is around 6 hours and 15 minutes of trade. 6 hours and 15 minutes of the day, which is less than 1/3. But most of the volume transactions happen here. But if you look at the other part, more than 2/3 of the day, you have only aftermarket session. So in this, there may be many people who are placing orders. These orders are all converted into trades between this 6 minutes or 5 minutes. So in this 5 minutes, whatever transactions take place are of the 2/3 duration of the day. On dinadalli, 2/3 of the day, 2/3 duration of the day, whatever orders is being placed are settled in this 5 minutes. So there may be chances of a rapid up move or a rapid down move of the share price being traded. So to allow a period of stabilization for them, this session comes in. The 3 minutes, 9:50, you can start trading. Okay. So this is the practical aspect. Now there is Diwali is coming up next month. So Diwali, you have something called as the Muhurat trading. Muhurat trading here, Diwali time. This is a special trading session which happens in India only, in Indian stock market. The timing is between 6:15 p.m. to 7:15 p.m. This is because part of the Indian culture, we look at auspicious time for everything. And ಒಳ್ಳೆ ಟೈಮ್ ನೋಡಬೇಕು, ಮದುವೆ ಮಾಡೋವಾಗಲೂ ನೋಡಬೇಕು, ಮೇ ಬಿ ಸಾಯೋವಾಗಲೂ ನೋಡಬೇಕಾಗಿರ್ಬೋದು. ಬಟ್ auspicious time works for everybody, may not work for everybody, but majority of Indian sentiment works on auspicious time. So 6:15 to 7:15 p.m. on the day of Diwali, on one day of Diwali. It can be any day of the week. It can be any day of the week. On the day of Diwali, 6:15 to 7:15 p.m. the market opens for 1 hour. Even in this market, you have a pre-opening session and a post-close session. The pre-opening session is between 6 to 6:15, where you can, where the previous orders are being matched. Let us say it was a working day, so between 4 to 6, whatever orders were placed, they will be matched during the pre-opening session. Trading occurs for 1 hour. Then post-close session will be 7:30 to 7:38, 8 minutes of post-close session, where the remaining trades of this, remaining orders of this are converted into trades, and then the market closes at 7:40 p.m. Now this was the Muhurat trading. Then other aspects that you need to look at. International transactions or international trade is also an important price determinant. So we look at something called the international market dynamics. This is important. Please, if you want to take a photograph of it, you can take it, or you can Google it up, or you want to note it down, you can note it down. This is important because I've given it in Indian Standard Time so that you can correlate it with your time today. So let us say there is a company, for example, Reliance Industries, or let us say Intel. Intel is listed in the US stock exchange as well as the Indian stock exchange. Let us say there is some news or some hunch or some news where people in US start buying Intel. So share price of Intel will go up in the US market. But its impact on the Indian market will also be similar, because Intel is not a separate entity in the US and in India. They do cross-border trades also. That is the reason why market sessions of other countries are important for Indian market. So anytime between this 7 o'clock in the evening to 1:30 in midnight of Indian time, USA market trades happen. So let us say Intel prices go up. Let us say someone who trades only in the evenings are awake at that time when Intel share prices in the US go up. They place orders in the aftermarket session in Indian stock exchange. The next day they will be rewarded very well. So you need to learn what time you look at what news. So they impact our trading even in other countries, from other countries. So USA, Europe, Japan, these are the 3 main ones. I've added Australia, China and Singapore. USA, Europe and Japan, 3 main things. Japan is ahead of our time by I think around 3 hours or 4 hours. 3 hours or 4 hours. USA is behind us by almost 10 to 12 hours depending on daylight saving. Europe is almost 5.5 hours behind us, Greenwich Mean Time. So then we have this concept of after market orders. No. ಇಲ್ಲಿ ಮಾರ್ಕೆಟ್ ಮುಗ್ದಾದ ಮೇಲೆ ಏನಾಗುತ್ತೆ ಅಂದರೆ ಜಾಸ್ತಿ ಟ್ರಾನ್ಸಾಕ್ಷನ್ಸ್ ನಡೆಯುತ್ತಲ್ವಾ, ನಡೆಯುವಾಗ ಏನಾಗುತ್ತೆ ಅಂದರೆ ದೇರ್ ಇಸ್ ಚಾನ್ಸಸ್ ಆಫ್ ಪ್ರೈಸಸ್ ಗೋಯಿಂಗ್ ಅಪ್. ಮುಂದಿನ ದಿನ ಬೆಳಗ್ಗೆ 9 ಗಂಟೆಗೆ ನೀವು ಶೇರ್ ಪ್ರೈಸ್ ನೋಡ್ತೀರಾ ಅಂದ್ಕೊಳ್ಳಿ, TCS ದೇ ನೋಡ್ತೀರಾ ಅಂದ್ಕೊಳ್ಳಿ, ಆವಾಗ ಆಫ್ಟರ್ ಮಾರ್ಕೆಟ್ ಆರ್ಡರ್ಸ್ ಅಲ್ಲಿ ತುಂಬ ಜನ ಖರೀದಿ ಮಾಡ್ತಿದ್ದಾರೆ. ಆವಾಗ ಏನಾಗುತ್ತೆ ಅಂದರೆ TCS ಶೇರ್ ಪ್ರೈಸ್ ಮೇಲ್ ಹೋಗುತ್ತೆ ಬಿಟ್ವೀನ್ 9 to 9:50. ಹಿಂದಿನ ದಿನ ಏನಾಗಿರುತ್ತೆ, ಲೆಟ್ ಅಸ್ ಸೇ TCS ಹ್ಯಾಸ್ ಕ್ಲೋಸ್ಡ್ at 1200 rupees per share. ಮುಂದಿನ ದಿನ ಆಫ್ಟರ್ ಮಾರ್ಕೆಟ್ ಆರ್ಡರ್ಸ್ ಅಲ್ಲಿ ಬೈಯಿಂಗ್ ಜಾಸ್ತಿ ಆಗುತ್ತೆ, ಡಿಮ್ಯಾಂಡ್ ಜಾಸ್ತಿ ಆಗೋದ್ರಿಂದ ಶೇರ್ ಪ್ರೈಸ್ ಜಾಸ್ತಿ ಆಗುತ್ತೆ. ಜಾಸ್ತಿ ಆಗುವಾಗ ಏನಾಗುತ್ತೆ ಅಂದರೆ ದಿಸ್ ವಿಲ್ ಗೋ ಅಪ್ ಟು ಲೆಟ್ ಅಸ್ ಸೇ 1280. ಹಿಂದಿನ ದಿನ ಕ್ಲೋಸಿಂಗ್ 1200 ಇತ್ತು, ಮುಂದಿನ ದಿನ ಓಪನ್ ಆಗುವಾಗ 1280 ಬಂತು. ಸೊ ದಿಸ್ ಇಸ್ ಕಾಲ್ಡ್ ಆಸ್ ಎ ಗ್ಯಾಪ್ ಅಪ್ ಓಪನಿಂಗ್. Gap up opening. There is a gap between 1200 to 1280. 330 ಹಿಂದಿನ ದಿನ ಪ್ರೈಸ್ 1200, ಅದಾದ್ಮೇಲೆ ಏನು ಫ್ಲಕ್ಚುಯೇಷನ್ ಕಾಣಿಸಲ್ಲ. 9:50 ಮುಂದಿನ ದಿನ 1280 ಡೈರೆಕ್ಟ್ ಜಂಪ್. ದಿಸ್ ಇಸ್ ಕಾಲ್ಡ್ ಗ್ಯಾಪ್ ಅಪ್. ಕಡಿಮೆ ಆಗಿತ್ತು ಅಂದರೆ ಗ್ಯಾಪ್ ಡೌನ್. ಅನ್ಚೇಂಜ್ ಅನ್ನೋದು ಇಟ್ಸ್ ಅ ವೆರಿ ರೇರ್ ಪಾಸಿಬಿಲಿಟಿ. ಏನಾಗುತ್ತೆ ಅಂದರೆ ಸೇಮ್ ಪ್ರೈಸ್ ಇರುತ್ತೆ. ದಟ್ ಈಸ್ ಬಿಕಾಸ್ ಇಟ್ ಇಸ್ ನಾಟ್ ಟ್ರೇಡೆಡ್ ಇನ್ ದಿ ಆಫ್ಟರ್ ಮಾರ್ಕೆಟ್ ಆರ್ಡರ್ಸ್. So with this, and I forgot one thing, Saturdays, Sundays and public holidays are holidays for the stock market also. And with this, I think we can wind up today's session. From tomorrow, we'll be looking at the different jargons